Hello, good evening everyone. A very warm welcome to all of you all on this call. As is usual and customary, I'll take you all through a brief presentation. Probably a lot has happened in the world in the last 3 months and 6 months. We'll touch upon all of that. I'm sure there are a lot of questions around global outlook and the global turmoil that we've seen. We'll touch upon all of that. So I'll try to use the time as effectively and efficiently as I can to give you all a perspective on outlook for Indian economy, some global perspective on global challenges, and outlook for Indian economy and markets. And we'll quickly wrap up with an update on performance of our funds. The good thing is, despite significant challenges in the last 6 months, our NSO funds have continued to do pretty well, and I'm pretty pleased with where we stand and about the outlook going forward. So I'll touch upon all of that. Without wasting too much of a time, let me just straight away jump into the presentation. So clearly, I think there is a recognition on globally now that India is the next economic miracle that's playing out in the world, and India still is an emerging economy. But we are on our path on a longer term basis to emerge, to make a transition from being an emerging economy to a evolved or a developed economy over the next 20 years. There's one big question, so I thought let me address the question right away, and which this slide actually reflects my view. So I wanted to make this as a statement. I clearly continue to remain pretty constructive on outlook for Indian economy and Indian markets, and I still believe that if you see this journey, right before COVID in February 20, Nifty was about 12,500. And if you look back in the last 5 years, Nifty has actually doubled despite a COVID crisis. Fell from 12,500 pre-COVID peak to about 25,000 is where we stand. And I believe that over the next 6 years, Nifty index can again double. So I firmly believe that, and that's our house view now, that we believe Nifty can get to 50,000 by 2031. And in the context, I think that effectively means about a 13% CAGR returns over the next 6 years, which is very compelling at the index level in terms of outlook. So I wanted to first address the elephant in the room. The first question I wanted to address was, from a slightly more longer term perspective, the outlook on Indian equity markets remains fairly constructive. Now, in this journey between 25,000 to 50,000 over the next 5 to 6 years, obviously we'll have economic and global turmoils, we'll have volatility in markets, and we'll have to navigate all of that. But for investors willing to take a longer term view, I think the only thing that we have to do is just stay invested and stay committed to the markets and not think otherwise. I think that's very clear in my mind and my thought process and in our investment approach as we execute our investment philosophy on a everyday basis. Clearly, I call this as India's great leap. India is in the midst of a big economic miracle. If you just think about this in the context, India is about a $4 trillion economy now. India has started clocking $1 trillion of economic output on a quarterly run rate basis, which effectively places us at a $4 trillion economy. And it has taken us about 70 odd years to get to this stage from the early 50s, where we were just about under $40 billion economy. The economic miracle that India is going to experience is that we have taken 70 years to generate an economic output of $4 trillion. And the point is, we're going to double the size of our economy over the next 8 years, which effectively means in the next 8 years, we'll once again create an incremental output of $4 trillion, which we took 70 years to generate. What we generated in 70 years in terms of economic output, we're going to generate in the next 8 years. All of us understand that stock markets at a very high level have a correlation with the size of the economy. So at $4 trillion economic output, India is a $5 trillion market cap. If India is going to double its economic output and become an $8 trillion economy in the next 7 to 8 years, there is no doubt in my mind that, as I said, Nifty will also double in the next 6 to 8 years, and I think more likely in 6 to 7 years than 8 years, and which is what I call a great economic miracle, because these kind of economic miracles happen for a period of 10-15 years in the life of economy, and this is India's time at this point of time. And anything and everything that's happening globally, good and bad, is unlikely to change this whole economic miracle cycle as it plays out in India, is my firm belief and conviction. So I thought I'll place that on record for all of you all. And also with that, let me also highlight to you all the performance, because all of us are interested in markets. If you look at Nifty 50 index, the index itself has been a great compounder over the last 20 years. And more importantly, a very steady compounder, meaning I thought I'll just put this together. So if you see Nifty 50 index over the last 20 years has done a 13% CAGR returns, and returns over different time cycles between 5 to 20 years have been somewhat similar, within a range or thereabouts. So meaning what simply I'm projecting is over the next 6 years, I think I'm just simply saying that the Nifty will do returns similar to the last 20 years, and which effectively means doubling of the index over the next 6 years in that sense. One good thing that has happened in India is, if you look across, this is the performance of the returns, annualized returns of the Nifty index for calendar year ending over the last 15 years. And if you see these returns, what's most interesting is the Indian markets have given positive returns in 12 out of last 14 years, which effectively means that anyone investing into Indian equities and staying invested for at least a year, his probability of making money is 85%. And if you stay invested for 2 years, your probability of making money is 100%. No other equity market in the world gives this kind of a high probability of success that India is given. Which is a reflection of the stability on the depth of Indian markets, and I think that is an outcome of the stability of the Indian economy. If you look back over the last 10 years, India has had a very stable macroeconomic fundamentals, friends. Our growth has been very steady. If you look at the last 10 years, Indian economy has averaged about 6.5% growth. Within that, we have had our own highs and lows. But our last 10 years, last decade's growth at 6.5% real growth is still very healthy and encouraging, I would say. And every other macroeconomic fundamental parameter has been very, very stable. Our fiscal deficit in 2013-14, when India was in the midst of a bit of a turmoil on macroeconomic fundamentals, was about 4.5%. And our fiscal deficit did increase during COVID when the government did a fiscal expansion. But now we are back to 4.8% last year, and this year FY26, the government will end up with a 4.4% targeted fiscal deficit. So our fiscal deficit has been very stable. Likewise, our current account deficit has been very much under check, and it's a known fact that we are a big importer of oil, and that has a significant impact on our CAD. And yet our current account deficit has been very stable at about under 1% or thereabouts, 1.2%. And in the process, in the last 10 years, we have doubled our forex reserves from $300 odd billion to $650 billion as of December, and recently we crossed $700 billion. The one big challenge we had 10 years back from India's macroeconomic fundamental was we were in the midst of a very high inflation. Our inflation had shot up to 9% in 2014. But over the last 10 years, I think our inflation has again moderated. And if you see average inflation post that has been about 4.5%. And in fact, recently inflation has undershot by a significant margin, and the current CPI inflation, the last reading we had, was under 4% after a gap of 4 years. So inflation, which was a somewhat of a challenge, has also moderated and has been pretty much under check. And the last 10 years, as I said, if you look through, India, despite all the turmoil that has played out globally across COVID and post-COVID, multiple things have happened. In midst of all of this, what really stands out is that India has had a very stable macroeconomic fundamentals. It's been a very stable and steady economy, compounding very steadily, and which is what is again reflected, as I said, into equity markets in terms of the consistent performance we have seen, where markets have delivered positive returns at the Nifty index level year after year on an annualized basis, meaning 85% probability of making money over a 15-year time horizon on a 1-year basis is a probability we can't find anywhere else in any other equity market in the world. And I think that's a great thing, which reflects, the underlying stability of India's macroeconomic fundamentals. And more importantly, all of us know that the economy did went through a slowdown. We had an economic slowdown starting, middle of last year. But the good thing is that the Indian economy has started turning around. So our GDP growth, which had, moderated from 7.5% to about under 5.5% in second quarter or in September quarter last year, has again troughed out in the third quarter and has started picking up again. Fourth quarter, March quarter GDP numbers was at 7.4%. So the GDP growth has already started improving on a sequential quarter basis. And I think this year should be a year of steady growth for India at 6.5% on a full year basis, which is pretty good, I would say. Likewise, our forex reserves have been pretty steady. We've recently crossed $700 billion. Inflation, which had spiked above 6%, which is the upper band of RBI corridor, has moderated significantly. And the last inflation reading that we had was under 3%. May was 2.8%, and June readings, once we get, should be closer to 3%. So inflation has moderated significantly. And as a consequence, what has happened, that opened the significant decline or moderation in inflation, gave the elbow room to RBI to go out and aggressively cut rates. We've already seen 100 basis points rate cut by RBI. And I think that's a very significant monetary stimulus that RBI has injected in the economy. And I think that will help revive consumption and in the economy in the second half of the year. But last policy, RBI front-loaded the rate cuts with a 50 basis point rate cut, I think, which was a pretty bold move from RBI. So what I wanted to highlight was through this, if you look through this, Indian economy, which had a cyclical slowdown for about 3 quarters last year, has clearly troughed out, and the economy has turned corner on a sequential quarter basis, which effectively means the economic momentum is back there. And I think all of that is also in a way reflected into equity markets, where markets which were in a correction mode from September last year did trough out or made a bottom in February at 22,000, and since then markets have rallied by about, I think, 14-15% from the lows, which is a pretty healthy or a pretty smart recovery that has happened in equity markets in that sense. And I think that's markets are taking cognizance of the fact that the economic fundamentals have troughed out, and economy is on a path of a cyclical recovery in that sense. So which again inspires confidence on the medium term and longer term outlook for the economy, that we are in midst of a cyclical recovery for the economy, and the low point of the cyclical slowdown is behind us. Yes, last 4 months have been pretty volatile from a geopolitical perspective. We've had the surprisingly Trump tariffs, big tariffs announced in 2nd April, and which took markets by surprise. And you can see, but despite we had currency adjustment by China in response to tariffs in month of May. We had our own security challenge with our neighbor for a few days in May, and then we had again escalation on the Israel-Iran front, where US got engaged again for a short period of time for a few days in June. You can see through in all of this, markets have been fairly resilient despite all of these events, which clearly is a reflection and a message that markets firmly believe that all of these are short-term disruptions or short-term events, and markets certainly don't believe that they will persist for long-term, or they will in any meaningful manner impact global growth so the market still firmly believes that the global growth will remain global economy has been fairly resilient despite all of these challenges, and market firmly believes that the economy continues to show strength, so global economy will continue to remain resilient, and which is where Indian markets have also been fairly resilient. And India, all of us clearly understand from what I shared earlier, is an outlier economy in the context of whatever is happening geopolitically globally. Except that one of the bigger concern I would think was when we got directly involved with our neighbor in a security scare, but thankfully for all of us, it was a very mature decision from Government of India, and it turned out to be a very short-term event over a period of 4 or 5 days, and we managed to get over it. It could have been a challenge if it would have persisted for a longer period of time. But the very fact that governments in India are very focused on economic growth, and as long as we can protect ourselves and keep our security in place, we certainly do not have interest in pursuing some of these things for a longer period of time, and which is where markets have been very resilient despite all of this, and it's reflected in terms of the very short term drawdown that happened in the market. But soon those events got over, market bounced back pretty sharply in that sense. And in all of this, all of us understand that India has been an outlier economy in that sense over the last 5 years, and that's very well reflected, friends, in if you see India's increasing weightage in global indices. One of the widely followed benchmarks for global investors looking to invest into Indian equities is MSCI Emerging Market Index. Now, if you look at this, in December 22, India's weightage in MSCI Emerging Market was about 8.2%, and 3 years out, given the fact that India has been the best performing equity market in the last 3 years, actually India's weight in MSCI emerging markets has actually almost doubled from 8% to about 16%, which effectively means that now that money has started flowing back into emerging markets from US, given the backdrop of weaker dollar, for every 100 rupees that comes into emerging markets, earlier India's due share was 8%, now that has actually doubled, which effectively means I firmly believe that as accelerated capital flows come back to emerging markets after a gap of almost 2.5 years, probably during the course of this year and next year, India this time around will get a much higher share of those capital flows than what India got 3 years back, just because of India's growing size and significant outperformance of markets in India. Our weightages in global indices has doubled, and directionally it's very obvious that as India grows and as our markets do well, directionally India's weight will keep increasing. I firmly believe that probably in another 3 to 4 years, India will get to a 20% weight in emerging markets index. So the 16% weight currently will move further to 20%, and which is a pretty positive sign in that sense that India will attract more and more capital, or will get more and more foreign capital. Sum total, if I look at the economic, if I step back for a moment and I look back at the economic picture, macroeconomic picture, both for globally and locally, so I think it's a very balanced outlook out there. Globally, there are some headwinds in terms of Trump is still not done with his tariffs, and he's announced a new set of tariffs for some of trading partners of US in the last few days, and we still do not have absolute clarity in terms of what is the outlook for tariffs that US want to impose eventually. And there is a lot of confusion because we've seen how Trump how impulsive he is in terms of making policy announcements and then withdrawing them. So I think all of that does create an environment of uncertainty from a global growth perspective, and all of that would mean and on the backdrop of a weaker US dollar would mean a slower growth in US or moderation in US growth, and that could slow down global exports or global growth for some of the countries which have over dependence on US for their growth. But at the same time, lower crude prices is a big driver, big incentive in that sense, or a stimulus for global growth that helps. And of late, China has spoken about some significant reforms in terms of reviving growth over the last few days. So as China injects more stimulus in the economy, which they will, both monetary and fiscal, and probably more policy reforms, and if China's growth stabilizes, that should be a big stabilizing factor for global growth. From a domestic perspective, as I said, we had a growth slowdown, cyclical slowdown in the growth, but I think that is behind us. The low point of that cyclical slowdown is behind us, and the economy is on a path of recovery. Having said that, I must concede that the growth recovery from here on will be more gradual and modest, and will not be a significant jump or a vertical revival in growth in that sense. Yet, as I said, at 6.5% projected growth for real GDP growth for this year and going into the next year as well, I think India will still remain an outlier global economy in the global context, because we'll still have the fastest growth amongst the major economies in the world, And in an environment where globally things are so challenged, 6.5% growth I still think is a very healthy growth in that sense. Markets have staged a sharp rebound from the lows. And at this point of time, while the recovery has been good, but that also means that markets are fairly valued at 21 times 1 year forward earnings, where Nifty index is. It places markets valuation in line with long-term averages. So markets are priced for perfection. Having said that, I still think that given that we will continue to have healthy earnings growth, markets will keep compounding from here on. But at this point of time, markets are not undervalued in that sense. They are fairly valued in that sense. And because markets have done well, one of the meaning concern in the market has been there is a significant capital raise that has been happening in the market through new offerings and QIPs that takes away a lot of capital from the markets and does create an overhang of supply in that sense. But I believe that that's also a healthy sign and it's a reflection of a robust underlying market in that sense. So I think when we look at macroeconomic picture both globally and locally, and when I look at markets as well, I think the picture is somewhat fairly balanced in that sense, with a steady growth over the next 3 years and steady returns over the next 3 years is what I would like to think about in that context, friends. Because we are talking slightly more medium term, long term, I thought I'll give you all a high level overview in terms of India's big growth drivers over the next 5 years as we navigate this journey from being a $4 trillion economy to $8 trillion economy. I think these are some of the India's big growth drivers as I envisage over the next 5 years in this transition. So obviously, investments will play a big role in India's growth acceleration from here on or in this transition, and both public and private investments. Public investment, the government has clearly defined the core areas, the 3 or 4 core areas, which is across defense, railways, infrastructure, including roads and highways. And the central government has actually tripled their investments in the last 5 years from COVID until now. The central government public investments has, on an aggregate basis, has gone from 3.5 lakh crores in March 20. During the onset of COVID to 11 lakh crores this year. So it's gone about almost over 3x in the last 6 years. So which shows the strong focus of central government on investments in reviving growth in the economy and making investments which are strategic and needed for the economy. At 11 lakh crores of annualized investments from central government, it's a very large number even from a global standard perspective. And this number will still keep growing at about 10-11% in line with the nominal GDP growth. So which effectively means in the next 6 or 7 years, central government investments can actually be to the order of 20 lakh crores. And probably India needs these investments across all of these core sectors because there is a massive need for better infrastructure across all of this. So I firmly believe that investments will be playing a very significant role in India's growth recovery going forward. Government of India has identified exports as a big driver for growth for India going forward. Our global market share in global exports is under 2%, which is much lower than a lot of our peers. Given that India is on the verge of signing a bilateral trade deal with US, and India would be tariffed much less than a lot of neighboring countries that India competes with, it's logical for India's exports to grow significantly, as India will be a beneficiary of the tariff war that's playing out in the world, because India will be tariffed much less than most of our neighboring countries. So it's logical for India's exports to increase significantly and India's market share increase significantly. Merchandise exports, which is meaning our market share, which is around 2%, Government of India really wants to double that at least in the next 6 years to over 4%, which effectively means our merchandise exports by itself will become over $1 trillion over the next 5 to 6 years. And on top of that, our services exports, we already enjoy a very healthy 4% market share in services export, but the target is to increase that to 6%. So exports is going to emerge as a very big engine or driver of growth over the next decade with incremental support from government. India is a large consumption economy. 60% of our economy, even at $4 trillion, is about private final consumption expenditure or comes from consumption. So which effectively means our overall consumption economy is about $2.5 trillion, and that's still growing at about 11% in nominal or absolute terms, which effectively means our consumption just Indian consumption will become a $5 trillion economy in the next 7-8 years. Even today, as we speak, at $2.4 trillion, it's the, I think just India's consumption is the 9th largest economy in the world. So clearly, India is a big consumer market, probably the next consumer miracle. The last consumer miracle happened in China over the last 15 years, where Chinese consumers became the biggest spenders in the world. And I think the next consumer miracle is going to be India, and which is where every global consumer company in whichever consumer business they are, whether in automobiles or fashion, either they're already there in India or they will have to be in India for their global survival, because this is going to be the biggest or the fastest growing consumer market in the world over the next decade or so. And finally, India is going to emerge as a big manufacturing hub for the world. China plus one, where global companies want to move their manufacturing base away from China or reduce their dependence on China and move away from China. India is the only alternate for moving large scale manufacturing away from China, and it's been supported by various incentive schemes from government. So that's working pretty well. And India is going to make massive investments in manufacturing or reviving India's manufacturing over the next decade. So manufacturing is going to be a very big engine of growth for India. Across some of these, you can see the massive investment numbers that we're talking about, or that's going to happen across new energy, whether it's in the entire energy ecosystem across solar renewables, or clean energy, including solar and wind and battery, hydrogen power, nuclear power, and so on and so forth, or across data centers and 5G, or across defense and railways. All of this are India is going to indigenize more and more importantly, global companies are going to shift their manufacturing base to India and probably use India as a base for exporting to a lot of other countries in the world. So manufacturing is going to be a big engine for growth for India. Sum total, all of this gives me a fair confidence that Indian economy continues to remain fairly resilient, and our dependence on external world for our growth at this point of time is much lower than that of the most other global large economies in the world, which effectively means global turmoil has much less impact on us in the world. And the second strategic advantage that we have, as I said, is in a world which is undergoing or facing a tariff war, India will be a relative beneficiary, because tariffs on India will be much lower than most of the other competing countries, which effectively means there is an opportunity for India to increase its market share in global trade meaningfully over the next 10 years. And I think all of this will play out, and which to me, all of this sounds very compelling when I just step back and try to look at the bigger picture and cut the noise from a day-to-day, global macroeconomic news flow that keeps playing out. If I just for a moment, step back from that and look at the big picture, I think the big picture for India looks very promising and has not changed despite the unleashing of tariff war and some of the global instability or turmoil that we have seen, or escalations we have seen. As I said, that's in a way a reflection of strong underlying growth of the Indian economy. Probably I can skip some, meaning these are some of the big underlying themes underlying these big drivers of growth. Opportunities portfolio, as all of you all know, is our large cap PMS strategy. 80% of the portfolio as we speak is large cap, and I find large cap very attractive in India because in an economy which is growing double digit in nominal terms, large enterprises can grow at a mid-teens to high-teens kind of a rate and still deliver very healthy returns, and all of those returns in large caps are coming at a much lower risk quotient in that sense. So clearly, I feel pretty excited about large cap as an opportunity, and which is where our opportunities PMS is. Just to take you through the fund. So as you see, as of 30th June, 80% of the portfolio is large cap, and the balance 20% spread across mid and small cap. The fund statistics, as you can see, the top 5 holdings and the performance, the sectoral dispersion. We have significantly added weight to financials as a sector in the last 6 months. So our weight in financials has gone up significantly, and financials now in this portfolio are close to about 40% of the portfolio. Our financial exposure is spread across both lenders, which is banks, and some of the other capital markets plays, including some of the other non-lending plays, including capital markets and insurance. Within lenders, we continue to remain very positive on banks, and now we own 4 of the top 5 banks of India in this portfolio, including HDFC Bank, Kotak Bank, State Bank of India, and ICICI Bank. So they are part of our top 5-7 holdings. And within the capital market plays, we own asset management company, which is HDFC AMC, and we have some exposure to insurance as well through ICICI Lombard, General Insurance. Sum total, we believe financials as a sector is pretty reasonably valued, and the growth outlook for the sector is pretty strong. So that's the biggest weight in the portfolio at about 40%, and the balance portfolio you can see is equally spread across. We have about 13% odd portfolio across consumers and information technology or IT, and then healthcare and is the other big holdings. It's a fairly diversified portfolio across 9 sectors and 27 names. The portfolio has done reasonably well in terms of performance. If you can see, last 3 years the portfolio has done a 23% CAGR returns versus Nifty 50 returns of 18.74, and last 5 years the portfolio has done 28% CAGR returns versus Nifty 50 TRI returns, total return index of 21%. So pretty healthy performance that we have seen from the portfolio in the last 3 across time periods over the last 5 years. Likewise, if you see our flexi-cap portfolio, the Indian PMS has done exceedingly well. The portfolio is fairly judiciously in terms of positioning, judiciously placed, and is a very well balanced portfolio with 54% allocation to large caps, and the balance across mid and small cap, evenly spread across mid and small caps. Again, within the portfolio, financials continues to remain our largest exposure with BFSI at 36%. And you can see the top 5 holdings on the left hand side. HDFC Bank and Reliance Industries and Tech Mahindra are part of our top 5 holdings, including HDFC, AMC and Infosys. And again, in terms of performance, the portfolio has done pretty well. Last 3 years, as you can see, the portfolio has done 28.9% CAGR compounded return as of 30th June 25 versus the Nifty 50 returns of 19%, 18.74 to be precise. And over the last 5 years, the portfolio has done an annualized returns of 39% compounded over the last 5 years, which to my mind is very strong returns, as compared to Nifty 200 index of 23% over the last 5 years. So it's been ranked amongst the best performing flexi-cap PMS on a 5-year performance. It's amongst the top 3 across all PMSs in India. So we are pretty pleased with the performance of the fund that we've been able to deliver over the last, over the last 3 years, 5 years, friends. Very quickly, I can touch upon the performance of ongoing AIFs as well. So our Indian X Fund 2, which is a closed-ended AIF, which is not open for subscription anymore, but has continued to do reasonably well, has done a 23% CAGR over the last 3 years. And likewise, AIF 3, the Indian X Fund 3, has done 13% return, 12.23% return in the last 1 year versus the index returns of 6.27%. So all our funds have been doing pretty well. The AIF 4, which we launched recently, again, last 3 months performance have been pretty decent, and the numbers are there for you. So sum total, all our funds have continued to do well, and all our funds have been beating the benchmark by a pretty healthy margin over the last 2, 3 and 5 years. And despite the volatility that we witnessed in the last 6 months, our funds were able to weather that volatility reasonably well. We have made some changes into our portfolio. I'm sure all of you would have seen that in terms of your statements or portfolio statements. One of the big shifts we have made, friends, in our portfolio is we have given the fact that meaning we are very conscious of growth of the underlying growth of our portfolios, but more importantly, we are also mindful of valuations of our investee companies, because buying high growth, high quality companies, but if you buy them at expensive valuations, you can still not make money for a reasonably long period of time. So what we have really done is we've exited, we've consciously taken a decision, and there are pockets, while at the aggregate level the index is fairly valued, there are pockets of market which we think are where valuations are significantly ahead of fundamentals. So as a conscious call, what we've done in the last 6 months is we've exited the most expensive part of the equity markets, or the top 20% of the listed public market, which is the most expensive part of the market, and where stocks are trading at 60-70 times forward earnings. Those kind of stocks where are the stocks where which we have exited from our portfolio, and because while we want to invest into high growth companies, but at the same time we want to make sure that we're investing into growth companies at reasonable valuations, in keeping in line with our framework of buying good quality growth at reasonable valuations, so that we do not run the valuation risk in our portfolio. All our portfolios across the board are poised to deliver mid-teens to high-teens kind of earnings growth over the next 2 years. And in that context, we think we should be good for mid-teens to high-teens kind of returns from our portfolio over the next 2 to 3 years, pretty much in line with the earnings growth that our portfolio will deliver. More importantly, we feel the companies that we own in our portfolios are companies who are leaders in their business segment or in the industry which they operate, and we have a very high degree of line of sight or visibility or confidence on the earnings projections or expected earnings outcomes from our investee companies. So the visibility is pretty high, and which is where we think the downside risk of our companies missing earnings estimate is pretty low in that sense. So we have a pretty high or pretty healthy line of sight in terms of earnings growth visibility for investee companies. So the other thing we have done in the last 6 months is, one, as I said, we've exited some of the very expensive stocks from the portfolio, and secondly, we've gone for a higher level of visibility or a higher level of certainty in earnings while selecting our companies in our portfolio. So these are companies which are leaders and are likely to deliver, which have high degree of certainty of delivering the earnings growth that we expect out of them over the next 2 years, which effectively reduces the risk from a portfolio perspective over the next 2 years, and which is what makes me feel good about outlook for our portfolio and our investee companies going into probably in this earnings season, which is just begun for the first quarter and going ahead into this year. So with that, I'm dot 45 minutes on the dot. I've given you all a quick snapshot of the performance of our funds. I'm happy to take a pause here, and I can see there are a lot of questions on the chat box. So I'll probably take those questions and try to answer some of those queries that all of you all might have, friends. So can we run through the questions, please? The first question is from Dhananjay Singh. In terms of his question is, how do you see Q1 results and the impact on the market? So the fact is, all of us know that because we had a cyclical slowdown in the economy, last year was not good from an earnings growth perspective. The Nifty 50 index did about 5% earnings growth last year. But I think the worst of earnings slowdown is behind us. Having said that, I think the first quarter earnings will still be more moderate and modest. But I certainly see a revival in earnings growth going into the second half of this year. So I think on a sequential quarter basis, first quarter earnings will be pretty much similar to what we saw in the last quarter, fourth quarter, which effectively is a signal that, please remember, the 2 quarters before that we were having earnings downgrade. So the downgrade cycle has stopped now. Earnings have troughed. I think earnings will have stabilized. So this quarter will be more a reflection that the earnings have stabilized from where they were on a downward sloping curve. And I think from here on, second quarter onwards, I expect we should start seeing a sequential improvement in earnings growth as the economy, as government spends have come back into the economy, and as the effect of rate cuts which RBI has done starts flowing into the economy, and we're already seeing early signs of recovery in the economy at the ground level. So I think all of that will start becoming visible from the second quarter onwards. So I think the first quarter earnings will be pretty much similar to what we saw in last quarter. It will be some more moderate and modest, but I think that's priced into the market. So I don't see that having a significant negative bearing on the markets in any manner. And I think we should expect a gradual recovery in earnings from second quarter onwards through the rest of the year. And I still think that on a full year basis, Nifty index can do a double digit, about 10-11% earnings growth for this year, and that could further accelerate going into the next year at 13-14%. So that is what I think, and in terms of the earnings for this quarter, friends. The next question is from next question, please. The next question is from Somit Shankar Das. uh, which is for a first time investor into PMS. Do you recommend opportunities portfolio, the large cap portfolio, or the flexi cap portfolio? Somit, both the portfolios are, have a positioning in that sense, and we really are committed to both our funds. So, depending on your risk profile, meaning you can choose between the two, a large cap or a flexi cap fund, and it's a more a function of a risk profile. Though on a 3-year basis, we certainly think our flexi cap fund, because of higher mid and small cap exposure, will do better in terms of returns than a large cap funds. The next question is from Vipul Vipul Sharma. Do you expect same stocks to contribute to your growth in your portfolio, or you intend to make significant changes? I think the question is, do we continue to own the same portfolio, or do we make significant changes? Vipul, we've made some very significant changes in our portfolio in the last 6 months between December and March or April of this year. If you see where, we've exited some of the very expensive part of the market across where P multiples are in terms of 60, 70 multiples and thereon, and where we had made a lot of money. And we have bought into some of the new stocks. If you see in our large cap and flexi cap stocks, after 3 years gap, we now own Reliance Industries. We bought in January. My primary view is that last 3 years Reliance has actually underperformed the equity market, but from here on, Reliance earnings have troughed. They had flat earnings or no earnings growth for the last 2 years, but I think this year onwards they will start reporting meaningful earnings growth and probably will accelerate into the next year. So now Reliance is very much a part of a portfolio, and my primary view is that Reliance as a stock will outperform the Nifty index over the next 2 years. So we've made meaningful changes in our portfolio in the last 4 or 5 months. We invest, as all of you all know, we as investors, we are slightly more longer term in our approach to investing. We do not trade the market, or we do not trade stocks on our quarterly results. We take a 3-year, 5-year view on businesses, and we invest for a medium term to long term. So we think our portfolios are fairly well poised to ride the economic growth recovery over the next 2 to 3 years in the economy. And they are the right mix of growth at reasonable price, and it's fairly diversified across sectors and across market caps in terms of large cap, mid cap, small cap. So we feel pretty good about the portfolio that we have in place, and probably if need be, we could make some small changes here and there as earnings season plays out and the economy evolves. But by and large, we believe that we have a portfolio in place for the next cycle over the next 2 to 3 years. Okay, the next question is, shall we expect the earnings growth and market momentum would be relatively less rapid as it was for the last 2 years? Yes, that's true, Vipul. I think we need to concede, or we need to acknowledge that see, the point is, friends, last 5 years, India's average growth between 2021 and 25 was 8.2%. And we had a strong rebounding growth post we came out of lockdowns from COVID, because there's a lot of pent-up demand that had happened during COVID. The economy now is much larger, and the economy is normalized. On this normalized base, the growth rate will moderate. Probably, I think over the next 3 years, India's growth will be between 6.5–7%. So yes, earnings growth will be somewhat lower than what we have witnessed in the last 3 years in that sense. I think next 3 years, probably Nifty 50 companies will do earnings growth of 12–13%. And I still think that that's a pretty healthy earnings growth in that sense on the base on which we are sitting on. And we would certainly like to have a portfolio earnings growth ahead of that. And I think our portfolios are in place for that in that sense. Next question, please. I think we have taken this question. Next question, please. The next question we have is from Neil Shah. If the economy is to grow to $8.5 trillion, do you estimate large caps to still compound in double digits? Good question. Absolutely yes. I think large companies in India, as the economy grows, these companies will increase their market share because of their dominant positioning, very strong balance sheet, and significant reinvestments that they are making and will continue to make in their business. which effectively means that these companies will grow ahead of nominal GDP growth and sector growth because they will take market share from smaller players because of their size and strength and their financial muscle. So there is no doubt in my mind that large caps will still do double digit, mid-teens, low teens kind of returns at the index level, and a good large cap fund can certainly do a mid-teens to high teens kind of a returns over the next 5 to 6 years or the next 10 years. So the answer is absolutely yes, Neil. The next question is from Pankaj Pathak. His question is, we have general elections in 2029. Will the change in government will have any impact on your view of Nifty of 50,000 Nifty by 2031? Okay, good questions. Well, obviously, we don't know what will be the election outcome of 2029, but the inference I'm drawing, going from past experiences, is that even when India has had coalition governments, India's economic policies have been very consistent. India has had some of the best economic growth under coalition governments in the past. So I firmly believe that as long as we have a stable government in place, whether it's a single party government or a coalition governments, the India's economic path of India's economic growth will not be impacted, because governments, whether they are coalition or single party, they do not, they are all interested in keeping the economic growth steady and strong, because they reap political dividends out of good economic growth. Good economic growth leads to prosperity, and that in turn translates into votes for governments. It's a tool for winning elections. So no government would want to take a chance with the economy or economic management, and to that extent, that view of economy doing well and index doubling over the next 6 years is irrespective of the government and overlooking the election cycles, because in a democracy we will have our elections every 5 years. So that's a given. The only thing that's not known is the outcome of elections. As long as, I firmly believe, as long as we have a stable government in place, whether it's a coalition or single party, we should be absolutely fine. The next question is from Omkar. Good evening, Omkar. Can you share your outlook on mid and small cap index? Well, my only view here is that there is a lot of froth in mid and small caps. So one should be very careful in terms of picking stocks. Currently markets are in momentum, so every mid cap, small cap stock is doing well. But it's very clear that the returns in the next 2 years in mid and small cap index will be lower than what we've experienced in the last 2 years. And secondly, not every stock in mid and small cap will make money. So one should be very careful in terms of what one is buying in mid and small cap this thing, because as I said, I see a lot of froth out there in mid and small cap. Having said that, I'm not saying that mid and small cap will not make money, but I'm saying last 2 years was a period where one could have bought any stock and one made money. Next 2 years stocks will make money, and if you do a wrong stock selection, one can still lose a lot of money. So just be careful about stocks you're buying. The next question is from Mahindra Prajapati. What is the impact on market due to high currency volatility? Do you think deflation is a risk going ahead in the market? Well, Mahindra, deflation is not a risk for India. India is not in a deflationary cycle, not at all. The only economy globally that's in midst of a deflationary cycle is actually China. And Japan actually is now come out of 40 years of deflationary cycle, where they've started seeing very strong inflation in the last year and a half. So in India is not into a deflationary cycle. So I don't think so deflation in any manner is a risk in India. In fact, India is in a very much an inflationary economy in that sense. So I don't see that deflationary as a risk in India, not at all. The next question is from Gaurav Gupta. How do you think Trump policies affect Indian markets? And is there any significant downfall in the market due to ban of Jane Street? Okay. Well, Gaurav, I do not see significant negative impact of any of Trump policies on Indian economy. And as I said, now that Trump has unleashed a tariff war in the world, now while the final contours of tariffs on different countries is still murky, and we don't know what will be the shape of it, because until it's done, it's not done. In case of Trump, as all of us know, that he is pretty whimsical and impulsive. But having said that, from whatever we know or what we have seen, clearly it stands out that India is a relative beneficiary of a tariff war. In a tariff war, I have said this earlier in some of my earlier presentations, that in any war, including a tariff war, there are no winners, though there are no absolute winners. Everyone is a loser, whether it's a physical war or a tariff war. The only winners are relative winners, which is that if you get hurt less than your neighbor or your competition, you are a relative winner. The way it plays out, so far from whatever we know of this tariff war which Trump has unleashed, India will be tariffed much less than most of our competing economies that we compete with in the global markets for our market share, which effectively means India will be a relative winner in this tariff war which Trump has unleashed. And outside of that, I don't see any of Trump policies having any negative impact on India's growth in that sense. There could be some second round impact on India's economic growth if, if global growth slows down. If Trump really goes with full-blown tariffs on some of the larger economies in the world, which again I don't think so is likely, because he's already softened his stance by trying to strike a trade deal with China at terms which are not so disruptive. So I somehow, meaning in sum total, I don't think so Trump policies have negative impact on India. On terms of Jane Street, I think all of us know there is one section of the market there where there is a huge speculation happening with derivatives volume. We've seen now reports that both the two data points that are relevant for me is, one, India has the highest derivatives turnover in the world, and the cash to derivative ratio in India was 600 times. The derivatives markets are doing volume which are 600 times the cash market, meaning the highest speculation anywhere in the world is happening in Indian equity markets. Certainly not a good sign. And second, 91% of retail investors are losing money in derivatives, and they're still doing that. Both of these data points are extremely concerning if you really ask me from any long-term player into Indian capital markets or Indian equity markets perspective. And I think this should correct both of these. The derivatives turnover should come down. We do not want our markets to be casinos. Equity markets have a real economic value in terms of they are an instrument of wealth creation, and they are not a place of casino where people come and lose money by punting. But we cannot stop people from speculating. So I think I don't see a negative impact of Jane Street. If at all anything, I think it will reduce level of speculative activity in markets by derivatives turnover coming down. And hopefully investors, with all of this messaging and data points out, investors will be more wise in terms of trading less and investing more, which again should be beneficial for them. So I think overall aggregate derivatives volume will certainly, I think, fall by 20-30% in Indian markets. To me, that's a good sign. That's a good thing, because we are over speculating. It's becoming speculative markets. Retail investors are losing money, and we need to stop that business. We can't let investors just just being greedy and losing money and getting into that trap of speculative activity. Yeah, I hope I've answered your question, Gaurav. It was a very broad question. The next question is from Vaibhav Pancholi. What is the short-term view on pharma sector? Well, I don't know what you mean by short-term view, but the view on pharma continues to remain positive, Vaibhav. Pharma as a sector has done well over the last 3 years. India has some very strategic long-term advantages in pharma as a sector or in the pharma industry. We are the lowest cost producer of drugs for the US generics market. For all the drugs coming into the US generics market from all over the world, the lowest cost of manufacturing is in India. Anywhere else, if you manufacture and try to sell in US, the cost of manufacturing is much higher than India. So given that context, pharma industry or the pharma sector will continue to do well. So yeah, the outlook is positive in pharma sector, if you ask me, over the next 1 year or 3 years point of view as well. The next question, we are dot on 5 o'clock, but I'll take last 1 or 2 more questions. And then probably I would request all of you all to, meaning we have your questions, probably we'll mail the answers to all of you all. The next question is from Virag. Where do you think are the better opportunities for the next 2 to 3 years? Small cap, mid cap and large cap. Well, Virag, the opportunities are not driven by market caps, they are driven by sectors and companies. I think if you're asking me if I've understood your question correctly, I think the best approach to approach the market from the next 2 to 3 years perspective is take a more balanced approach and have a balanced portfolio spread across large cap, mid cap and small cap, have balanced exposure across sectors, and which is where our flexi cap PMS is at about 55% large cap exposure and the balance 40-45% across mid and small cap. So taking a more balanced approach over the next 3 years, I think is the best approach in terms of targeted returns and managing risk as well. The next question is from Harshini. What are the risks to the India story? Good question. Well, the risk to India is 2 or 3, Harshini. I think so. One clearly is risk. We saw we saw that risk play out in some manner over a period of 4 or 5 days in April, between April 7th and April 10th, and which is on May 7th to May 10th, and which is that we do not share a good relationship with our neighbor, and both our neighbors, China and Pakistan, are nuclear powers. We are the only country in the world to share borders with nuclear powers. Nowhere else in the world two nuclear powers share borders. India is an exception where we share borders with 2 nuclear powers, and unfortunately we do not have friendly relationship with either of our neighbors, and we don't trust each other. There is a trust deficit for reasons, and I don't think so that can be resolved, that trust can be restored amongst neighbors, India's neighbors. So that's always a structural risk which India always carries forever. I think so that is a very significant risk, I think, from India. For India as a country, I would think, and that risk has always been. It's not something which happened yesterday or day before yesterday. This risk has always been there, and it will continue to remain for the rest of our lives because we cannot change geographies. But for that, from a geopolitical or a macroeconomic perspective, I do not perceive significant risk for India. One of the big risks always that has been for India is our energy insecurity. We import 90% of our energy. We import 90% of the energy, meaning oil represents about 60% of our, or 65% of our energy consumption is through crude oil, and 90% of that is imported. So we are dependent on the external world for importing our energy, and if crude oil prices rise very sharply, I don't think so that is going to be the case for the next 2 years given the demand supply dynamics of crude. But in the past, it has so happened that crude oil prices have risen very sharply and gone beyond $100 and $120. So if crude oil prices rise very sharply, that poses a risk for India's economic growth, because that effectively means that our import bill doubles, and then that leads to escalation into our CAD, current account deficit, and that has multiple implications in terms of our macroeconomic fundamentals for currency, inflation and everything else. But we are in an environment where crude prices are benign, and they'll probably continue to remain benign for the next 18 months at least, given the demand supply dynamics of crude. So these are the 2 big structural risks I see for India. Everything else is a cyclical risk. Any other risk is a risk which might emerge, but anything that emerges can be solved in 2, 3, 4 quarters. So I don't count that as a very significant risk in that sense. Even if something plays out, it can be course corrected in 6 months, 9 months, or within a year's time. So if you really ask me, for a long-term investor like ourselves who thinks about investing from a 3-year, 5-year perspective, these are the 2 big risks, and outside of that, I don't see significant risks to India growth story. With that, friends, we've already exceeded the time. So I would like to thank all of you all for taking a valuable time out on this Friday evening and joining us for this update, this discussion on markets and update on Renaissance portfolios. There are a lot of questions which, because of the paucity of time, we've not been able to address, but we'll certainly reply to those questions and send the replies back to all of you all. We have your email addresses, so you will hear from us with all your replies soon from our team. And with that, I would like to thank all of you all for taking a valuable time out on this Friday evening. Until we meet next quarter, friends. Thanks a lot, friends. Thank you.